This strategy will allow us to make money both ways. Now remember, before you ever enter this options trade or any other options trade, please make sure you know how to close it. I'll pin a video in the comment section below where I show you guys how to close out of any options trade. So let's quickly go through our goal here today. So our goal with this strategy is going to be to profit from a stock price move either up or down with limited risk. So again, in other words, we're going to be able to make money both ways here. And so the ideal situation here is you believe a stock will make a move, and it's not going to have to be a huge move, by the way, but you're just not sure which way it's going to go. So for example, there might be some sort of world event going on, Fed meeting, FDA approval, things like that that can really cause a stock to move, but you're just not really sure which way. And so what I'm going to do for today's video is I'm going to be using ticker symbol KO here, Coca-Cola. So keep in mind that what I'm going to show you here is just an example, so don't copy this exact same trade. But let's just say that we think Coca-Cola could potentially make a move up or down here from current levels. And again, as you'll see, it's not going to have to be a really big move. Now, before we go into the options here, there's always two very important things you always need to check. First thing is commission fees. We are going to be opening and closing multiple contracts here today. If you're on a broker with high commission fees, that might eat away at a lot of your profit. Now, Robinhood doesn't have any commission fees, so we don't have to worry about that on here. Number two, we're going to be selling options. Anytime we sell an option, there is risk of assignment. We want to avoid being early assigned due to the ex-dividend of a stock. So you should always check, does a stock have a dividend? If it does, check when the ex-dividend date is. You want to avoid selling options on the week of the ex-dividend. If you do sell options on that week, you want to close out 2 days before. So remember, we can always go to NASDAQ.com and check if the stock has a dividend, and if it does, when the ex-dividend date is. So Coca-Cola does have a dividend, and that's kind of partly why I chose this for today's video, so we can check when the ex-dividend date is and where you would find that. So here you would click on dividend history on the left, and then here it will show us if the stock has a dividend, and if it does, when the ex-dividend date is. So let's just take a look here. So the ex-dividend date just happened actually. It looks like it was on March 14th. So we don't have to worry about, early assignment due to the dividend over the next few weeks here with Coca-Cola. So now that we've checked those two things, we can come back in here and go into the options here. So again, today we're focusing on the short call butterfly option strategy. So firstly, right off the bat here, you do not need 100 shares of the stock to implement this strategy. And as the name suggests, short call butterfly, short because we're going to be implementing this for a credit, right? So in other words, you're going to get a credit when you enter this strategy, and then call because we're only going to be using calls for this strategy. So we're already filtered on calls here. We're only going to be using calls. And the first thing you want to do here is you want to choose a proper expiration date. So again, the ideal situation here, what you want to happen is you want this stock to make a move either up or down from the current price levels. So let's just say I think over the next 2-3 days, Coca-Cola is going to make a move here. And again, as you'll see, it's not going to have to be a big move. So I'll just leave it as April 14th for my expiration date here. Now, here is where we actually start to get into the options and choosing the proper options here. So we're going to actually be choosing 3 different strikes here and entering 4 options. So the first thing you want to do is you want to determine if this stock ends up going up in price, what price is it going to go above? And what you want to do is you're going to want to sell a call at that strike. So let's say, and I'm just going to exaggerate here a little bit, but let's say that if I think Coca-Cola is going to go up, it's going to go above $70. So what I'm going to do is I'm going to go ahead and sell a call at that strike. So if I think it's going to go up, it's going to go above 70, I'm going to sell a call at the $70 strike here. Now, the other thing I want to do now is if instead I think the stock, if instead the stock ends up going down, I wanted to try and determine what price it will go down under. So let's say that if it moves down, I think it's going to go under $60, which is right here. So I'm going to go ahead and sell a call there as well. So far we're selling 2 calls. I sold one at 70 because I think if Coca-Cola goes up, it's going to go above 70. And then I sold a call at 60 because I believe if Coca-Cola is going to go down, it's going to go under 60, okay? Now, what we need to do one more thing here, is we want to choose the option that's right in between the 2 calls that we're selling here, right? So in other words, what you want to do is you want to add both of these strikes. So if I add that 70 plus 60, that gives me 130, and divide that by 2, that gives me 65. So that's going to be the option that's right in between these 2. So the $65 strike. So what I want to do here then is I want to go ahead and buy 2 call options now at this strike. So I'm going to switch to buy now, and I'm going to buy 2 calls right at this strike. And again, it's very important that this one is right in between the 2 calls that you're selling. Right, so now the distance between the lower call that I'm selling and this call that I'm buying is the same as the distance between the higher strike call that I'm selling and the call that I'm buying. They're both 5 away from the calls that I'm going to buy here. So now what I want to do is I want to click on this drop down, go to custom, and then for the calls that I'm buying, remember I want 2 of these, not just 1. So I'll do 2 here. And so this is what it's going to look like here. And as you can see already, it's going to have a pretty nice reward to loss ratio. So my max loss, $76, max profit, $425.26 or so. So again, you're going to be entering this for a credit, implementing it for a credit. And so of course, you're going to have to put up collateral here. And so again, this should be implemented for a credit. And as you can see already, from this chart, we're going to be able to make money both ways here. Now, before you actually enter this trade, again, it's very important that you visually take a look at what's going to happen here with your trade, what your profit loss will be depending on the date, depending on the price of the stock, depending on implied volatility. This really only shows you what it looks like on expiration date. So I like to go over to option strat instead to visually take a look at what this is going to look like. So let's go over to option strat here. Let's go to build. And they actually should have a calculator already for this. So under directional, you'll see short called butterfly. So we can click on this here since it's already set up for us and use this. So we chose ticker symbol KO here. So Coca-Cola. We left our expiration as April 14th. And so again, we started by saying if the price of Coca-Cola goes up, what price do we think it's going to go above? So we chose 70. 70 is already chose here. So we sold a call at 70. Then we said, okay, if Coca-Cola goes down in price, what price do we think it's going to go under? We said 60. So we sold a call there. That's already here as well. And then we went right in between these 2, which is going to be the 65 here. And we bought 2 calls there. So this actually already has the strikes we chose. But let's take a look here at what this is going to look like. Okay, so again, we're implementing this for a credit, $427 for this example. Max loss will be around $73. And so your max profit should be the credit you're receiving, $427. And we're going to be able to make that max profit both ways, up or down. And then, of course, we have our break even. So we either want to be below 64.27 to break even, or we want to be at 64.27 or below, break even and make money, or at 65.73 or above, we'll break even. At 65.73 above, we'll make money. Now, a couple of things I want to mention here. So firstly, let's talk about what we ideally want to happen here, the ideal situation. So the ideal situation here is for the stock to be at the strikes of the call you sold. So right here at 70 or 60, or below this lower strike or above this higher strike, because that's where you're going to make your max profit. So for example, if on the 14th, we're at $60 strike here, as you can see, we'll make $427, which is our max profit, right? Because that's the strike of the call we sold down here. If it was anywhere under that, we'd still make our max profit. Now on the upside as well, if we are at $70, we will make our max profit. And if we're above that, we'll also make our max profit of $427. Now, as you can see, it doesn't have to go all the way to the strikes there though for you to make money. In fact, like I mentioned, as long as we're under 64.27 or above 65.73, we'll make money here. So for example, let's say Coca-Cola drops 2.2% here, we'll make 97 bucks. However, if it goes up 2.2%, we'll make 47 bucks here. So again, what's nice about this is it doesn't matter which way it moves. As long as it moves, and as you can see here, it doesn't have to move a lot, you'll end up making some money here. And so the other thing I want to mention here is the max loss, right? Because the max loss is 73, but there's only one place here where you're actually going to lose your max loss. That's going to be if on the expiration date here, the strike or the price of the stock is at the strike of the calls that you bought. So the only place you're going to lose $73 here, which is your max loss, is going to be if on the expiration, this stock ends up being exactly at $65, which is very, very unlikely, which means it's very unlikely that you'll ever actually lose your max loss here. Because again, for it to be exactly at 65 on the expiration, it's very unlikely, right? If it starts to go above that, you start to lose less and less. If it starts to go below that, you start to lose less and less. And in fact, we can see that here if we take a look. So like I mentioned, at 65, that's the only place you're going to lose your max loss. If it starts to go any higher, you start to lose less and less. Similarly, if it goes any lower, you start to lose less and less. So that's the other thing that I really wanted to mention there, guys. But anyways, the other thing, of course, is you don't have to wait until the expiration to take your profit. You can close out any time before the expiration. So for example, if it's April 13th, Wednesday, and this is up, 2%, then go ahead and close out for a $40 profit, right? You do not have to wait until the expiration to take your profit. And of course, the other thing that I always like to mention here is changes in implied volatility and how that affects the trade here. So IV here is 34%. Remember, there's always this slider on the bottom right that you can choose, you can modify here and toggle to see what this looks like. So if IV goes down here for this strategy, as we can see, it's not really going to change a whole lot. If IV goes up here, you'll also see that it's really not going to change extremely a lot here, right? So there's not an extreme change when IV changes here. And that should be expected because we are buying the same amount of options that we're selling. And so it kind of almost cancels out here. There is a small change, but nothing too dramatic here, as you can see. So anyways, this is the short call butterfly spread, guys. Again, this strategy allows you to make money both ways. You want to implement this strategy when you think a stock is going to make a move. You're just not sure exactly which way that move is going to be. So anyways, if you guys have any questions about anything I just talked about, feel free to leave them in the comment section below. Check out the Discord, link to it in the description below. Hope you enjoyed the video. Let me know what you guys think, and I will see you guys next time.